Hello, good morning. I hope you're all doing fine. And I hope you're having a great time. So today I want us to look at something small here. This is basically the model that I use to trade, and it is called the fractal model. And we are going to look at it step by step from how we do analysis from the top down to our entry. And what I want you to notice that we only use the daily candle to give us our bias, because we have to start from a higher time frame bias, go down to our intermediate time frame for our market structure, and then we can take our entries from a lower time frame, that is mostly the 5 minutes. So if we can start, I have some few notes here, we can go through them. And yeah, so introduction to this, it is called the fractal model, and it basically entails understanding that price cannot reverse without forming a swing point. Yes, so we always form a swing point before price can reverse. So it is just a simple concept, but very powerful when paired with a structured top-down analysis or approach, and it helps us as traders to identify high probability setups by aligning what you notice here is that we use the daily time frame, the hourly time frame, and the 5 minute time frame. So that is what we call time frame alignment. So if you're using your daily time frame, you're going to, as your higher time frame, you're going to use your 1 hour for your structure, and then the 5 minutes for your entry. So in this guide, we are going to break down the candle numbering system for swing points, and how to form a daily bias using candle closures, how to confirm change instead of delivery using the 1 hour, which is our intermediate time frame, and how to refine our entries using the 5 minute chart. So the foundation of this model is to identify a swing point and candle numbering. So you have to, and that is where we are using the higher time frame, which is our daily time frame. So at the core of the fractal model is the idea that price cannot reverse without forming a swing point. We always want to form a swing point before price reverses. If you are going up, we need to form a swing point before price can reverse, and this becomes our swing point. Yeah, and so when it comes to candle numbering system, we normally we have candle 1, 2, 3, 4, and this is how in this example, in case of from bearish to bullish, candle 2 is the swing low, and in case from a bullish to a bearish, candle 2 is our swing high. So we have this candle 1, which is number 1. We have our candle 2, which forms our swing low, because now we are changing from bearish to bullish. Now we have our bullish candle 3 and 4, and the opposite is true. If we are to reverse this, now our candle 2 would be our swing high if you are moving from bullish to bearish. That is, if you are moving from bullish, you are going this to this. Now our candle 2 here, which forms our swing high, will be our swing point. Yeah, so I hope you have understood that. So now coming down to how we do analysis from up to down, that is top down analysis. Step 1 is to establish our daily bias. We want to start by establishing our daily bias, and you can never drop to 1 hour until you have one-sided daily bias. The market, you can either buy or sell. You only have two options. You only have two options in this case. So you have to start by having a clear sense of direction. Where do you want to see price go? Do you want to see price go higher, or do you want to see price go lower? Because those are the only options that you have. So when it comes to establishing our daily bias, there are rules that we have to follow. So if price closes below the previous day low, expect a continuation lower. So you realize we have said we use the candle closure to establish our bias. How to form a daily bias using closures. So in this case, if we close below the previous day, we expect now the next day to continue lower. And if price fails to close below the previous day lower, we expect a reversal. So, and same logic applies to previous day high, but inverted now. So the opposite of this is true in case of if you fail to close, or rather if price closes above the previous day high, we expect continuation higher. And if price fails to close above the previous day high, we expect a reversal lower. Yeah, so this is just an example, ideal scenario. So we have identified a swing point on daily where a reversal closure occurs, then plan to trade the continuation the next day. So in this case now here, look at this. We took out this previous day low at this point. We took out previous day low, you can see, and failed to close below this. And so what do we expect now? The next day we expect now price to continue higher, because now we have formed our swing low, which is our candle 2. So we look to trade candle 3 and candle 4, and this is a reversal candlestick. So we expect now candle 3 and 4 to expand higher. So and the opposite of this, in this example here, you see we failed to, we closed below this previous day candlestick. So we expect now price to continue lower. Yeah, so this is a continuation and this is a reversal. So we expect price to reverse and higher. And now in this example, because we closed below the previous day low, we expect now to see price continue even lower. Yeah. So that is our step 1. So we already have our bias. These are two scenarios. We can either have a reversal or a continuation. So after establishing our bias, we go down now to our 1 hour chart for confirmation. Once the daily bias is established, locate the candle 2 swing point on the daily. So we want to locate this candle 2 on the daily time frame. I mean on the hourly. So we want to locate candle 2 of the daily time frame on the hourly. So we drop down to 1 hour and then confirm a change in state of delivery in the same direction. So if you're expecting to, in this case, to continue higher, if you're expecting price to continue higher, so we want to see because it's a bullish candle in this case in this case, so we expect price to continue. So we expect price to open low and then high and then close, because this is how a bullish candlestick is formed. So we expect price to open at this point, trend lower first of all to form the low of the day, and then continue higher and then close. So at this point here is where we are going to look for our change in state of delivery, because we are trading the continuation candlestick. Okay, yeah. So from that, as you can see in this chart, so look for price in the upper or lower half of the previous day range and at a point of interest, e.g. fair value gap on order blocks. So in this example, look at this. I want you to focus on this. So we had a liquidity sweep. We had a liquidity sweep at this point. We had a liquidity sweep at that point. So and then look at this. We had a change in state of delivery. So after establishing our bias, we expect now price to continue lower. Look at this. We had a change in state of delivery at this point. And then we had a fair value gap. Look at this fair value gap here. We had this fair value gap. And you can see price came to this fair value gap and continued downwards. So this is where we would take our entry. a change in state of delivery plus a fair value gap. And you can see now this hourly candle is very bearish. So we expect now price to continue downwards. And this is now our, at this point is where we have our bearish CSD at this point, where we had a closure below this series of up close candles. So at this point we had our change in state of delivery, and then we had a fair value gap. So, and you remember I said a fair value gap plus a change in state of delivery, it's a very strong confirmation for entry. So you can take your entry at the midpoint of this fair value gap and your stop loss at this point, and then you can target 2R. Yeah, so after that, so you have gone down to one hour, and you have confirmed our change in state of delivery. So step 3 is you can refine your entry on 5-minute chart. So once the hourly setup is validated, drop to the 5-minute chart, confirm a change in state of delivery counter to hourly on the 5 minutes. So you realize what you are doing from a daily perspective, you are doing it also to an hourly perspective. So align with points of interest that match your bias. Points of interest, they can be order blocks, they can be fair value gaps. Because now we are bearish, we want to consider bearish fair value gaps and bearish order blocks. So use your protected swing highs or lows for your stop loss, and then target logical liquidity put or a higher time frame key level for best risk to reward ratio. In our example here, you can see now we had our 5-minute change in state of delivery. Also at this point we had a fair value gap, 5-minute fair value gap, and this is where we took our entries. Our stop loss was just above here, and you can see price went to we were targeting a ratio of a risk to reward ratio of 1:2 or 1:3, and this is what price did. So you can see this candle here confirmed our change in state of delivery, and you can see we had left a bearish fair value gap, and you can see price was respecting every bearish fair value gap. So our order flow was bearish. So we now took our entries from this point and continued lower. Yeah, so that is all that pertains to this model. Just simple. So in just a nutshell, we look at this. We start from a daily perspective. So you can see here we took out previous day high and closed below previous day low. So we expect now the next candle to continue lower. So the next candle we expect an open high low close candle, because that is how a bearish candlestick is formed. So after that we go to 1 hour and look for a change in state of delivery at this point, because we had an open. So we look for a change in state of delivery at this point after we have opened, gone higher, and then after closure below that we had our change in state of delivery. That is in an 1 hour chart. So this is what we are saying. We open, went higher to form the high of the day. You can see we also had a candle 2 closure in 1 hour. So we took out that high, which is a liquidity sweep, and then we continued downward. So what I want you to notice is that for a change in state of delivery to be very valid, we want to see first a liquidity sweep. Not every change in state of delivery is valid, because you have to wait for a liquidity sweep. And this is one mistake that we make. We don't wait for a liquidity sweep to occur. For example, in this example here in 1 hour, look at this. We had our first change in state of delivery at this point, but this was not valid because we didn't sweep any highs. So we didn't have any liquidity sweep, and you can see we were leaving relatively equal highs here, and you can see price returned, took out these highs and continue downward. So if you had taken your trades from this point, you'd have been stopped out because you took an early entry. You didn't have a clear confirmation. You want to see a very a clean liquidity sweep before having a change in state of delivery. So after that, you can go down to your 5 minutes and take your entries. Yeah, that is it. Just a simple model you can use. You only need to use your daily candle so that you can frame the next expected move. So, and the model is just that simple. So you start from a daily, observe how the previous day candle closed, taking note of the previous day high and lows. How did price react to that? And then you can now anticipate where price will be headed to the next day. And now you can go down to 1 hour, look for a change in state of delivery after liquidity sweep. You can enter at a fair value gap, and what I want to see is a change in state of delivery with a fair value gap, because price will come to rebalance that imbalance and continue downwards. And yeah, so I hope you will find this helpful. You can backtest this, and I hope you will benefit from it. Yeah, so thank you and enjoy.